The guidelines below were prepared by Mr. G.C. Zakos, Principal and Lecturer at Aristotelian College of Marketing Management for more than 25 years. Mr. Zakos holds a BSc degree and an MBA postgraduate degree from Wits University, 1977. The compilation of financial statements, both income statement and balance sheet, is often required by the IMM Graduate School of Marketing for both assignments and examinations. The procedure and detailed explanations that follow will assist you to do well in both the assignments and examinations. Point 1. The organization will usually have an accounting system in place which captures and records most, but not all, of the transactions occurring during the year. These transactions are usually recorded in the firm's journals. The journals are then totaled on a monthly basis and posted to the firm's ledger. A ledger is a book, manual, or computer operated, which is divided into 4 major sections. Section 1, Expenses. This section contains the expense ledger accounts such as depreciation, cost of sales, wages, and many others. The ledger accounts, which are shown on an individual basis, reflect the total expenses incurred in each case for the whole year. Section 2, Assets. All assets, current and non-current, are listed in this section on an individual basis. For example, furniture, plant and equipment, motor vehicles, and many more. Section 3, Liabilities. This section contains ledger accounts for each of the liabilities at the end of the year. This section includes such liabilities as bank loans, trade creditors, or tax owing. Section 4. The last section includes income and capital ledger accounts. For example, sales generated for the year or capital invested by the owners in their business. Point 3. Drawing up pre-adjustment trial balances. The totals or balances for each ledger are listed on what is known as a trial balance statement. The expenses and assets ledger balances will be under the debit column, and liabilities and income ledger balances will be under the credit column. Note that the totals of the debit and credit columns should equal one another. Point 4. Journalize the adjustments. As mentioned in point 1 above, the accounting system, i.e. the ledger accounts and pre-adjustment trial balance, does not include all transactions that took place during the year. Some transactions have been taken, but the accounting system is not aware of them. Examples of such transactions are depreciation for depreciable non-current assets, for example furniture and machinery. This has not yet been calculated or entered into the system for the current year. The firm may have become aware of additional bad debts which occurred at the end of the year and after the pre-adjustment trial balance was drawn up. The provision for bad debts must be adjusted in line with the economic and business environment. Some expenses or incomes must be brought into account. For example, the accounting system needs to be made aware of their existence. This is in line with the accrual and prudence concepts. Each additional transaction must be journalized, i.e. the effect of each transaction on the ledger accounts must be acknowledged. This usually means that a ledger account balance increases and other ledger account balances decrease, or the same ledger account balances increases and at the same time decreases, meaning they will remain unchanged. The golden rules for journalizing transactions are: to increase an amount or expense, balance or total, we debit the relevant ledger accounts, and vice versa. To increase liability or owner's equity and income balances or totals, we credit the relevant ledger accounts, and vice versa. Point 5. Making the adjustments. Using the journal entries in point 4 above, make the necessary adjustments or additions in cases where new ledger accounts are required to be added to the trial balance statement. In practice, this means increasing or decreasing the balances or totals of the pre-adjustment trial balance. Now you can draw up a new updated trial balance, otherwise known as the post-adjustment trial balance. As always, the totals of the debits must equal the total of the credits. Point 7. Draw up the income statement, also known as the Statement of Financial Performance. Use the post-adjustment trial balance to construct the income statement. Simply identify the income and expense amounts from the post-adjustment trial balance. Remember, income amounts are listed under the credit column and expense amounts are listed under the debit column. Now you're ready to draw up the balance sheet, also known as a Statement of Financial Position. Having completed step 7 above, use the remaining balances in the post-adjustment trial balance to construct the balance sheet. Simply identify the assets, liabilities, and owner's equity balances from the post-adjustment trial balance. Remember, assets are shown in the debit column of the trial balance and liabilities and owner's equity are shown in the credit column. Note, the retained profit from step 7 must be transferred into the owner's equity section of the balance sheet. Retained profits equal profits after tax for the current year, less any drawings or dividends declared. Final thought. Remember, the Aristotelian College of Marketing Management in Bedfordview provides top quality tuition, individualized attention for all your questions. If you have any further queries or would like to find out more about Aristotelian, below please find our telephone and fax numbers together with the email and website address.